This is an overview of economic and accounting costs and profits. Economist versus accountant. Accountants and economists differ in analyzing the performance of a company. So, accountants focus only on explicit cost, and economists focus on explicit and implicit cost or other opportunity costs. Explicit costs are the input costs that require an outlay of money or the expenditure of money, like wages, utility bills, rent, and other operating expenses. Whereas implicit costs are the input costs that do not require an outlay of money, like foregone benefits, foregone savings from investment, etc. Let's see accounting cost and economic cost, and accounting profit and economic profit. Accounting cost equals explicit cost plus depreciation, whereas economic cost includes both explicit cost and implicit cost, and implicit cost includes normal profit and economic depreciation. Profit equals total revenue minus total cost, and total accounting profit equals total revenue minus total explicit cost. Normal profit is equal to the best return that the firm's resources could earn elsewhere. Economic profit equals total revenue minus total explicit and implicit cost, and implicit cost including normal profit. These are formulas. TR, or the total revenue, equals price times quantity sold, and total cost equals explicit cost plus implicit cost. Profit equals total revenue minus total cost. Accounting profit TR minus explicit cost, and economic profits is TR minus explicit cost plus implicit cost, that is foregone wages, implicit cost of capital. Implicit cost also includes economic depreciation and normal profit. Economist versus accountant, or views of cost and profit. So you can see here the first column is the normal profit earned by a firm. The second column shows the economic profit, and the third column shows the economic loss. Let's discuss the normal profit earned by a firm. So in the example, you can see the firm is earning a revenue of $2,000 in the first case, and you can see the explicit cost, wages, operating cost, and interest expenses are all comes under economic explicit cost. So total is 1,850, and the accounting profit, which is total revenue minus explicit cost, is 150. So the accounting profit earned by the firm is 150. Implicit cost of the firm are shown below as foregone wage income, which is 100. That is, if the firm's owner who has started this business was working elsewhere, he was earning $100. So that is his foregone wage income. And foregone return on $500 investment is 10% of interest he could have earned. So 150 is the foregone wages and the interest, or the implicit cost of that firm owner. So normal profit means zero economic profit, because he's not making profit after meeting all his expenses, both explicit and implicit. So it is just enough for him to stay in business. So at this moment, he can decide either to stay in the business or go elsewhere. So this accounting profit is just covering his foregone profits. The second comes the economic profit. So here the company or the firm is making a revenue of $2,100 a year. And you can see it is covering all the explicit cost, and the accounting profit, which is total revenue minus explicit cost, here is 250. It is also covering his implicit cost of 150 and earning an extra profit of $100, which is his economic profit. It is over and above his total cost, which is covering both his explicit cost and implicit cost. So it is, this profit is above average or normal profit. The third case is economic loss. Here the company is earning a revenue of 1950 and it is covering and this revenue after covering the explicit cost, you can see the accounting profit of 100. So this 100 doesn't cover the entire implicit cost here. So here the firm is incurring a loss of $50 as it is not covering the entire implicit cost of a firm owner. So it is not profitable from the economist's point of view, but profitable from the accountant's point of view. It is this time, since it is not covering his implicit cost, it is better for the firm owner to invest in some other business.